Building a vehicle requires a global network of synchronized manufacturing. But when an unexpected cost arises, someone has to absorb the financial impact. This is Stellantis Portugal, formerly known as General Motors Portugal. They operated as a national sales company. Their role was to import vehicles from European manufacturing hubs and distribute them across the Portuguese market. In that capacity, they absorbed a specific set of operational costs. Following an audit, the Portuguese Tax Authority issued the company a €1.5 million value-added tax assessment. Regulators targeted financial transfers sent to the Portuguese company from its parent manufacturing entities in the US and Europe. The dispute hinged entirely on how to classify those funds. The tax authority categorized the money as payment for a taxable repair service. The company argued the transfers were simply holistic transfer pricing adjustments meant to guarantee a target profit margin. This conflict exposes exactly what happens when regulators mistake a multinational's internal accounting mechanics for a taxable, standalone economic transaction. To resolve this classification dispute, the case escalated to the Court of Justice of the European Union. The court applied this standard, the 6th VAT Directive. Article 2 taxes the supply of services for consideration. Article 6 defines this, but case law requires a direct, legally binding link between the service provided and the payment received. That direct link only exists if there is reciprocal performance. One party must perform an identifiable service, and the other party must provide actual remuneration specifically for that service. To legally validate a €1.5 million tax assessment, the Portuguese regulators could not simply point to money moving across borders. They had to prove that a specific reciprocal contract for repair services existed between the parent manufacturers and the Portuguese sales branch. To see if that specific service contract existed, we have to map the physical flow of vehicles and money. Looking at this structural map, the original equipment manufacturers in the European Union produce the vehicles and ship them to the national sales company in Portugal. The Portuguese branch then sells those vehicles to independent dealers, who put them in the hands of final customers. When a vehicle has a manufacturing defect or requires warranty work, the customer returns to the local dealership. The independent dealer performs the physical repair. The dealer then bills the Portuguese sales branch for that repair work, applying standard VAT to the invoice. This places the initial financial burden of the warranty repair squarely on the national sales company. While the Portuguese branch pays the invoice, they never actually touch the cars. They absorb the cost of the repair, but they do not perform the mechanical labor. The financial relationship between the European manufacturers and the Portuguese branch was governed by a 2004 transfer pricing agreement. As we can see in this equation, Clause 1.0 of that agreement was designed to guarantee the Portuguese branch a previously determined fixed profit margin on vehicle sales. The initial transfer price of the vehicles was calculated by taking the expected external sale price and subtracting both the distribution costs and that locked target margin. The distribution costs variable was heavily aggregated. It included the fees paid to dealers for warranty repairs, but it also contained general corporate overhead, staff salaries, marketing budgets, and electricity bills. Because costs fluctuate, Clause 4.0 mandated an end-of-period review. If actual financial results drifted away from the guaranteed margin, an adjustment was required. If the Portuguese branch incurred higher distribution costs, whether from rent hikes or excess warranty repairs, their profit margin would drop. The parent manufacturer would then issue a credit note, effectively lowering the transfer price of the vehicles after the fact to push the branch's profit back up to the target line. Conversely, if the branch overperformed and exceeded their target margin, they would issue a debit note. The branch would pay the manufacturer, lowering their own profit to strictly align with the agreed-upon percentage. These mathematical adjustments act as systemic balancers for corporate accounting. They manage overall profitability. They do not pay itemized invoices for specific actions. This brings us to the Portuguese Tax Authority's error. As shown on the left side of this model, regulators looked at the situation and assumed a direct linear transaction. They saw the branch paying for repairs, then receiving money from the manufacturer, and concluded that the parent company was directly reimbursing the branch for a repair service. But when placed next to the actual transfer pricing mechanics on the right, that assumption collapses. The financial transfer from the manufacturer was diluted among total overhead costs and dictated entirely by the need to hit a target margin. Regulators isolated a single variable, repair costs, from a complex corporate formula to fabricate a taxable event. Taxing one component of a holistic margin guarantee formula misrepresents the actual economic purpose behind the transfer of funds. The Court of Justice examined the 6th VAT directive against this reality. Looking at paragraph 38 of their decision, they found no clause in the 2004 agreement requiring the Portuguese branch to repair vehicles in return for remuneration. In paragraph 43, the court noted adjustments included operating costs and could trigger debit notes, forcing the branch to pay the manufacturer. A service provider paying the client contradicts a service fees definition. Thus, paragraph 45 concludes the link between repairs and adjustments is only indirect. Without a direct link, the basic legal threshold for a taxable supply of services under Article 2 has not been met. The final ruling concluded, a transfer price adjustment guaranteeing a profit margin does not constitute consideration for a supply of services. However, paragraph 47 clarified these funds don't escape taxation. Under Article 11, they must be treated as a subsequent amendment to a price. National regulators must evaluate these adjustments as retroactive changes to the initial purchase price of the vehicles, rather than inventing a phantom repair service. In the realm of multinational operations, the exact mechanics of an internal contract dictate reality. Whether a document outlines a fee for service or a margin guarantee determines the legal framework regulators must use to view the money.